welcome to another segment of ARA in Conversation, where we delve into the key issues surrounding real estate investment with regard to investment managers and investors around the world. Today, we're going to be talking with Sabrina Unger, our Managing Director of Research and Strategy, and we will be talking about distress in the real estate market and what that means. And the real question is, it's really an interesting one, is there really distress, or is this just a figment of our imagination? And so, Sabrina, what I want to do is begin with the conversation surrounding the fact that we have $1 trillion of debt that is maturing in this next year. We have bank reserves that are going up because of defaults. Our defaults in our banks in the commercial real estate industry have almost doubled in the last year. What does this mean? And how does this impact real estate investing? And how do you think about that?
Yeah, I think we have to first contextualize how real the distress in the market is today and the potential distress, because there's sort of two buckets that we need to be focused on. If you look at the end of 2023, we had something like $85 billion of real estate loans that were already distressed. So these are loans that the lenders have identified as falling effectively into default, delayed in payments. So that's a huge bucket of money right there. And then we have another 230 billion that is potentially distressed. So it's right on the cusp of moving into that distressed category. These are big numbers. So when we think about, how far along are we in the materialization of this distress situation? Is it real? Should it be concerning, or is it getting overblown? It is big numbers. And so we're past the opening credits, but it's going to be a long movie. If I think about it in the realm of Titanic, we're probably not to the second VHS yet, right? So there's a lot that needs to be worked through. The concerns are warranted, I think, because not all of these loans are going to come through the current environment unscathed. So, but we may have been a little premature on thinking that it was going to materialize sooner than what it actually will.
So help us contextualize this again in a different way. How do we wind up in this position? What's the genesis of all this?
Yeah, so, I think thinking back, not that long ago, interest rates were low. When you went to invest in a real estate property, adding debt or leverage was accretive to returns, and it was relatively affordable to do. So if we think about an example, if you're an investor who had maybe the unfortunate timing of buying an office property at the end of 2019, there was really affordable accretive debt. So you go to buy a $100 million office property for simple math. You take a 60% loan to value. So effectively the loan's $60 million and you, the equity contributor, have to come up with $40 million. Get a 5-year loan, and then the pandemic hits, your occupancy takes a hit. When things start to recover, now you're having to compete for leasing. So it's costing more in tenant improvement, more in leasing commissions. Meanwhile, interest rates have went up, your values have declined. So now you're sitting in 2024 and that loan that was very low, maybe it was 2%, is coming due in an environment where loans are, 6, 7, 8%, depending on the profile of the asset. So you now are faced with effectively 3 decisions, which is 1, you can just pay off that loan. But again, if the value declined, the amount of the outstanding loan may be equivalent or more to the value of the building. So where are you going to come up with the money to pay off that loan? So that's one scenario, but it's probably not super likely. The second is you sort of deal with the environment and say, I'm going to refinance. But again, because the value has declined, now that loan to value is thrown off. You have to come up with more equity. So again, people probably are not generally in a position where they want to do that, particularly for office, put more money into a property that just lost 40% of its value. But that's option 2. And the third option, which is what the markets are really concerned about, is effectively you default on that loan as it comes due. You don't want to, pay it off. You don't want to put more equity in. And so you effectively hand the keys to that property back to the lender, right? And so those are your 3 scenarios. And it stems from an environment where for so many years, debt was very cheap, easy to get, and was accretive to your returns. And now we're in an environment where it's considerably more expensive to refinance and the values have declined. Office is probably in the worst place with this because it's getting hit really with a triple punch, right? It's dealing with lower occupancy, work from home, we have the capital markets, the interest rate environment, which is making it more expensive to refinance. And you also just have lower values, right? So 1, 2, 3, it's very difficult to justify refinancing, especially in office, given this environment. And so that's where a lot of the concerns about true default are coming in.
So that's a lot to unpack. And I want to sort of parse this out for a moment and try and understand this. So where's all this capital going to come from that's going to be necessary to be able to, A, refinance this debt, or to remargin these loans that have to be bought down, as you talk about?
Yeah. So again, I'm going to pick on office a little bit because it represents something like 41% of the distressed loans today. And we know that that's really the problem spot from a fundamentals perspective, as well as representing a big portion of the debt. Where does the capital come from? Well, it's likely not going to come from the CMBS market because they, already have something like 30% exposure. Lenders have already said they don't want to be lending to office right now. They're a little apprehensive about lending to real estate, but especially office. So you're not going to see them plug the gap. Where I think you're seeing more capital get churned up is from non-traditional lender sources. You're seeing funds be raised to fill that gap, which is great. I think the challenge, though, is these funds, what their target return is and what they're willing to accept from a risk return profile may not match up with the assets and profiles of deals that are going to need that lending to step in. So there may be a mismatch in the market between available capital that wants to be placed, sort of as an alternative, and what's going to be available for them to step into. So we may still see a challenge there, but I think that is an opportunity where non-traditional lenders are going to get an opportunity to step in where the banks have stepped back.
Let's frame this a little differently, because office has become the punching bag of every media company, and sitting down there talking about the way that office is performing. And we all know that there's real issues there. But let's move to industrial and retail and multifamily, because certainly what we have seen is in multifamily some real shifts that have occurred, because when you buy it, as you said, a 3.5 cap rate, and now we're in a 6 cap rate environment, it's materially different in terms of your debt coverage. How do you think this plays out in those areas?
Yeah, I think, again, looking at the composition of what is already distressed today. So office is 41% of what was distressed at the end of 2023. But if we look at sort of the next tier of what constitutes that bucket, it's lodging, retail, and apartments. Combined, those three sectors represent 54% of distress. And when you look at potential distress, so it hasn't moved into that threshold, but it's close, a lot of it is apartments. So I think that's going to create a really interesting buying opportunity, because the longer term fundamental outlook for rental residential is much stronger than office. And so I actually think there's going to be a really interesting buying opportunity for groups, because there were so many multifamily deals that had really interesting financial structures that are no longer viable in today's environment.
So when we think about managing in a distressed environment, most of the asset management team in most firms are too young to really understand what it is to be able to manage through a cycle like this. And the management skills that are necessary are very different than what you would do in a market that is robust and upwardly moving. I mean, pretty easy to be able to lease when everybody's leasing property, very difficult to lease when nobody's leasing property. And you have to change those strategies and link it then to your debt strategies. Have you thought about that in terms of talking to your investors and how they should be thinking about that?
Yeah, I think the focus has been, and what we've been communicating and will continue to communicate in this environment, is focusing on the resiliency of your NOI, or your net operating income. That is so pertinent today, because you have to be a first mover. If you're in a multifamily market facing a lot of supply and you have a debt consideration to be thinking about, you need occupancy. So you need to be on the front end of offering concessions if that's warranted in the market, ensuring that you're retaining tenants so that your cash flow stays as stable as possible. Again, pre this era of higher interest rates, the idea was you wanted to churn tenants because there was an ability to increase rents. Today, I think the focus has shifted to the resiliency and stability of income. And that's also going to be rewarded, I think, first by the capital markets, because there's still so much uncertainty that if you're going to refinance or work with your lender, they want to see a stable occupancy profile. So I think that's critical.
So we sit in our investment committee, and this is a favorite topic of ours, is do you talk about buying office? Do you not talk about buying office? And what are the political implications with your investors? And how do they perceive that? Or even buying into this market today where you don't necessarily know where basis is given the distress that is occurring. How do you think about that? And is there an opportunity that we're missing? Should we go be buying office buildings in downtown LA at $70 a foot because the replacement cost is $1,000 a foot? And is there going to be real value there? Give us some context on that.
Yeah, I think it ultimately depends on your structural view of fundamentals and demand, because it's great to be able to get a building at a good basis, but it only benefits your portfolio if you're able to lease it up and get cash flow on it and then sell it at the end of the day. So if you buy a building at 70% below what you would have bought it for a few years ago, that sounds like a great deal. But if you can never get it leased up and you're facing chronic vacancy issues and the taxes are going up around you and it's more expensive to operate it and to manage it, that's not a great buy. And so I think it really comes back to what is your fundamental view on whether we have a return to past, return to office that is commensurate with what we had before the pandemic. I think that's the first part. And then assuming at some time in the future, we do come back to 5 days a week, is it in the same locations? Or have people fundamentally distributed in such a way where downtown LA will struggle for much longer than some of the submarkets on the west side, because not only did the businesses sort of up and leave, but their employees live over there as well. And we have to think about things like commute. So I think it really comes down to what's your fundamental view of the recovery of demand and over what period of time. Because again, it could be a great buy today, but if you don't think you're going to be able to sort of make money for 10 or 15 years, probably there's a better place to make that investment.
So as you and I talked about in our House View conversation several weeks ago, one of the things that we're going through right now is what I call the Great Reset, the Great Basis Reset, where basis is all being reset to a much greater opportunity for people to buy. So I think what we want to do is let everybody walk away from this conversation realizing that even in the midst of distress, there are opportunities to be able to capitalize and to be able to invest.
Yeah, absolutely. I think, vintage year is so important. Basis is important. And there are going to be some good basis buys that come out of the sort of reset. So I think it's an exciting time to sort of think about what happens for the next cycle.
Well, Sabrina, thank you. This is a great conversation. I appreciate your being here to be able to share this with us.